Welcome to Everything You Need to Know About Finance. We are really thrilled you're joining us for another deep dive into the world of finance. We're here to cut through the noise, get straight to the insights you need.
And before we jump in, just a quick but, well, crucial note for everyone listening. Everything we're about to discuss, it's strictly for informational and educational purposes. That's it. We're presenting data, insights, gathered from various reports and analyses. But this is not and should absolutely never be taken as financial advice. Please, always do your own thorough research, or even better, chat with a qualified financial professional before making any investment decisions. Okay, your financial well-being is key.
Absolutely. Couldn't agree more. With that important disclaimer out of the way, today we're taking a focused look at a company that, well, it's truly been a roller coaster ride in the solar energy sector. SolarEdge Technologies, NASDAQ ticker FEDG, will be navigating through its recent stock moves, diving deep into its latest financial health, and exploring the often conflicting views from analysts and institutional investors. We want to give you a clearer, well-rounded picture. It's really a fascinating case study in market dynamics and, well, company resilience too. Okay, let's unpack this. So let's start right at the beginning. For those maybe less familiar, what exactly is SolarEdge? What's their core business?
Okay, so SolarEdge Technologies. It's an Israeli company founded way back in 2006. Their core thing, they design, develop, manufacture, and sell DC-optimized inverter systems. That's for solar photovoltaic or PV installations. Basically, think of it like this. Solar panels make DC power, right? But homes, the grid, they use AC. SolarEdge's inverters, they're crucial for converting that DC to AC and doing it efficiently, making the whole system more productive, safer too. They also have an energy storage segment, so they play a really critical role across the whole solar ecosystem. Headquarters are in Milpitas, California, and they employ nearly 4,000 people globally. So yeah, significant player.
Okay, so a key innovator in solar tech, making green energy more efficient. Got it. But, like we hinted, for anyone watching the market, SolarEdge's stock journey has been, well, anything but smooth. Pretty dramatic story, actually.
Yeah.
What's the recent performance look like, and how does that stack up against its past?
Right. Well, if we look at the very immediate past, today, June 17th, 2025, the stock opened at $23.98. It actually closed up 2.92% from the day before. Outperformed the S&P 500, the Dow, the NASDAQ, just for that single day. And it's also climbed 5.81% over the past month. So on the surface, you see some positive momentum there.
That sounds, well, promising, at least in the very short term. But that roller coaster description, that has to come from somewhere, right? What's the bigger historical context here?
Yeah, and that's where it gets truly fascinating, While we see these little green shoots recently, SolarEdge had an incredibly challenging few years. Just picture this. Back in November 2021, peak of the, well, some called it the green energy bubble, right? The stock's hit an absolutely astounding all-time high, $368.33. A huge meteoric rise. Then fast forward to June 25th, 2024, it plunged nearly 15% in just one day, dropped to $28.41. And to really put it in perspective, for the entirety of 2023, SolarEdge was the single worst performing stock, the worst, in the S&P 500. And that poor performance actually led to it being delisted from that prestigious index earlier this year.
Wow. Okay, from over $300 a share down to struggling near $20, $30, and then delisted from the S&P 500. That really hammers home the scale of the fall, puts the current $23.98 in stark perspective. For our listeners, what does being delisted from an index like the S&P 500 actually mean? Is it just symbolic?
Oh, it's much more than symbolic. It has real, tangible impacts. See, when a company gets delisted from an index like the S&P 500, it means a huge number of institutional funds, especially the passive ones that just track the index. They have to sell their shares. They just can't hold a stock that isn't part of their benchmark anymore. And that creates immense selling pressure, often regardless of the company's fundamentals, which can drive the price down even more. Plus, it reduces the company's visibility, its liquidity. It's not automatically in those big influential fund portfolios anymore. So yeah, while SolarEdge had a great run-up, that delisting was a very public, very painful acknowledgement of its struggles.
That makes perfect sense. Almost like being kicked out of the big leagues, right?
Exactly.
Given all that volatility, what's its trading range look like over, say, the past year? And we often see different market cap figures thrown around. What's the story there? Any clarity?
Sure. Over the past year, SolarEdge has traded between a low of $10.24 and a high of $40.47. That really reflects that continued volatility we've been talking about. The market's still trying to figure it out. As for market cap, you'll see different numbers. One analysis might put it around $1.42 billion. Another might peg it closer to $867.95 million. This kind of discrepancy isn't necessarily a red flag, But it just highlights how these figures can vary, right? Depends on the exact share count used, the time of calculation, maybe whether all outstanding shares are included. It's just a reminder to, always check the source and consider the time frame of the data.
Excellent point on data variations. Okay, so we've established the stock's really dramatic journey. Now let's shift focus. Let's dive into what's driving some of these movements, particularly its latest financials. We have results for the first quarter of fiscal year 2025, ended March 31st, reported May 6th. What do the top-line numbers look like?
Okay, Q1. They reported revenue of $219.48 million. What's interesting here is that was actually up 7.4% compared to the same quarter last year. That's a positive sign, growth-wise. And maybe more importantly, it beat analysts' expectations. They were looking for something closer to $205.39 million. So yeah, they delivered on the revenue front, exceeded those projections.
Okay, encouraging on revenue. But revenue doesn't always tell the whole story, does it? Especially for a company that's been in such a challenging spot. So the big question, how did that revenue translate to profitability?
Right, and that's where the picture gets a bit more complex. SolarEdge reported an earnings per share EPS of negative $1.14 for the quarter. Now, while that's still a loss, it was actually better than the consensus estimate. Analysts expected negative $1.26, and it represents a 40% improvement, meaning, less negative compared to the prior year. So yes, still in the red, but the losses are narrowing, which is, a step in the right direction.
So still losing money, but losing less money. Progress of a kind, I suppose. But what about those truly staggering negative return on equity and net margin figures you mentioned? What do they really tell us about the company's underlying health, efficiency?
Yeah, that's where the rubber meets the road, and it's important not to just gloss over these. Their net income was negative $98.52 million. Again, an improvement year over year, about 37.37%. However, that negative return on equity at 95.05% and a negative net margin of 192.13%. Those are very, very significant. A negative ROE of 95%. It's not just a number. It means for every dollar shareholders have invested, SolarEdge is effectively losing almost that amount. And the negative net margin, it basically says for every dollar of revenue they bring in, they're spending nearly $2 to generate it. These aren't just, minor efficiency issues. These are deep structural challenges. It screams costs are out of control relative to sales. And they're eating into shareholder value at an alarming rate. It's a really stark contrast to their improving cash flow, highlights the complex balancing act.
That's a powerful way to put it. Drawing that clear line between improving losses and actual efficiency.
Yeah.
Okay? Given those figures, especially the profitability challenges, what does this mean for operational health, day-to-day finances? Because cash flow, like you said, can often be a truer indicator of stability than just accounting profits, right?
Exactly. Connect it to the bigger picture. It's not just about that accounting profit or loss. It's about actual cash. And here, SolarEdge actually delivered some surprisingly positive news. They reported positive cash from operations. $33.82 million. That's a huge jump. 115.59% increase year over year. Their free cash flow also jumped. $18.07 million, up 110.46%. This is crucial. It shows that despite the accounting losses, the company is generating more cash from its core business. It means they're not burning through cash at the same rate. They have more operational stability. It's a key positive sign amidst all the red ink. They're managing their working capital much better.
That's a really fascinating contrast. Losing money on paper, but generating cash operationally.
Okay. And what about the balance sheet itself? How's their debt situation? How liquid are they? Can they cover immediate bills?
Yeah, the balance sheet actually provides a more reassuring view. They've got a debt-to-equity ratio of 0.56. Means they're using more shareholder money than borrowed money to finance assets. Generally, anything below 1 is considered pretty healthy. They're not overly leveraged. Then you look at their liquidity ratios. Quick ratio is 1.46. Current ratio is 1.95. Let's break those down quickly. Quick ratio of 1.46 means they have 1.46 times more quick assets, cash, receivables, stuff they can convert quickly than short-term debts. So they can comfortably cover immediate bills without selling off inventory. And the current ratio, 1.95, even stronger, confirms they have nearly twice the assets to cover all their short-term obligations. So yeah, despite the ongoing unprofitability, these numbers suggest they're quite liquid. Not on the brink of, immediate financial distress. They have a decent financial safety net. That's a really comprehensive look under the financial hood. Thanks. Now, here's where it gets really interesting, I think. The outlook from Wall Street, which seems to be sending some pretty mixed signals. We saw a significant recent downgrade, right?
That's absolutely right. KeyCorp, and it was echoed by KeyBank, recently downgraded SolarEdge, took it from a sector weight rating down to an underweight rating. and they assigned a $16 price objective. That suggests a potential downside of over 33% from the stock's previous close of $23.98. An underweight rating that basically implies the analyst expects the stock to perform worse than the overall sector. It's a strong bearish signal.
Okay, yeah, that's a pretty strong vote of no confidence from that particular firm. How does this compare to the broader analyst community? Is this a widespread feeling?
Well, the consensus among analysts looking at data from MarketBeat is actually a hold rating for SolarEdge, but, and this is important, the consensus price target is around $16.96. Guru Focus aggregates 26 analysts, gives an average target of $18.24, both implying, significant downside from the current price. Around 24% downside based on the Guru Focus average, so even the hold consensus is generally pointing lower than where it's trading now. It's also worth noting the sheer range, though. Some analysts have targets as high as $100, others as low as $5. That's a massive spread. Really highlights just how divided opinions are on SolarEdge's future.
That wide range definitely underscores the uncertainty. Okay, so a hold consensus, but with price targets generally below the current trading price. But I seem to recall there being more optimistic views, maybe from some bigger names earlier in the year. Has something shifted?
Yes, absolutely. There's definitely been a shift in sentiment more recently. Back in February, for example, Goldman Sachs actually upped their target to $31, had a buy rating. Royal Bank of Canada also had a sector perform rating, target of $15, and UBS Group increased their target to $20 just in early June, though they kept a neutral rating. So a recent KeyCorp downgrade and this current consensus reflecting a generally lower outlook, they're likely influenced by broader industry concerns that have really impacted the whole solar sector lately.
Okay, what are those broader industry concerns? Because, yeah, if we're talking about the whole sector, SolarEdge isn't operating in a vacuum. What are the headwinds?
Well, a major factor has been regulatory uncertainty. Specifically, there's been talk of a proposed Senate bill suggesting cuts to solar and wind energy incentives. And those incentives are absolutely critical, for driving adoption and profitability in renewables. Any hint of them being scaled back creates immediate concern right across the industry. Beyond that, the sector's also faced challenges with rising interest rates, makes financing big solar projects more expensive. Ongoing supply chain complexities, too, component sourcing, logistics. And then there's just fierce competition, especially from Chinese manufacturers, which puts pressure on pricing and margins for everyone. So it's really a multifaceted challenge, not just something specific to SolarEdge.
Right, that paints a much clearer picture of the landscape they're operating in. But despite these downgrades, the broader sector headwinds, what about the big players, the institutional investors, the hedge funds? Are they pulling back too?
And this is where the story gets really intriguing. It's quite the opposite, actually. Institutional investors and hedge funds, they own a huge chunk, 95.0% of SolarEdge's stock. Shows just how much big money is involved. And interestingly, we've seen some pretty large firms actually increasing their stakes in the first quarter. Edmund D. Rothschild Holding SA, for example, lifted its holdings by a remarkable 60%. Fifth Third Bancorp raised its position by 93.7%. And notably, Jones Financial Company's LOT grew its stake by over 400%. 400%. This suggests a very different view from some of these large institutional players. Maybe they're focusing on longer-term potential, seeing value where short-term analysts see risk.
Wow. Okay, this truly raises an important question then. We have downgrades from some analysts pointing down, but then increased buying from major institutional investors. Then you throw in the Guru Focus estimated fair value for SolarEdge, projected at $32.82 in 1 year. It's just, 36.86% upside from its current price? How do we, as listeners, reconcile these completely conflicting signals? It's like Wall Street is sending two totally different messages here.
It's fascinating, isn't it, that divergence? And it really comes down to different investment philosophies, different time horizons. The GF value, for instance, it's a proprietary model. It suggests that based on SolarEdge's historical multiples, past growth, future estimates, the stock should be trading higher. It points towards its, let's call it, intrinsic value. However, the recent analyst downgrades, they're typically reacting to more immediate stuff, market conditions, those industry headwinds we talked about, the company's continued unprofitability, even with the better cash flow. Analysts often focus on the next, say, 12 to 18 months. So you've got these fundamental models suggesting long-term value, analysts reacting to short-term pressures, and then these large institutional investors possibly looking at an even longer horizon. Maybe they're betting on the long-term growth of solar itself, or the company's strong tech position, or even seeing it as a distressed asset that'll eventually recover. It just perfectly reflects that tension,
Yeah.
between long-term intrinsic value and short-term market sentiment, and how different players interpret risk and opportunity. The Zacks rank also gives SolarEdge a #3 hold, which kind of aligns with the analyst consensus, but it's worth noting the overall solar industry itself, part of the oil's energy sector, ranks in the bottom 29% of all industries tracked by Zacks. So even within that challenging group, SolarEdge is trying to carve out its path.
Okay, so putting it all together, what does this really mean for you, the learner, trying to make sense of SolarEdge Technologies and maybe the broader solar sector too?
Well, you're looking at a company with a strong, foundational position in a growing sector, renewables. That's undeniable. It has shown tangible operational improvements, positive cash flow, even while it's still navigating persistent unprofitability. That's the tricky part. Its stock, extreme volatility, soared to incredible highs, rewarded early investors hugely, then crashed dramatically, got delisted from the S&P 500. Yet, amidst these recent analyst downgrades pointing to more potential downside, you have large institutional investors, the ones with deep pockets and long-term views, actively increasing their positions. And then some fundamental valuation models suggest significant upside from where it is now.
It truly presents a nuanced, almost paradoxical picture, doesn't it? So here's a provocative thought to leave you with. In a sector as dynamic and, frankly, essential as solar energy, and for a company like SolarEdge, facing both significant immediate headwinds and these underlying operational improvements, how do you weigh the short-term skepticism of some analysts against the apparent long-term conviction of major institutional investors when considering a company's future? Is it about patience, riding out the storm? Or is it about avoiding that storm altogether right now? Something to think about. Thank you so much for joining us on this deep dive. If you found this discussion insightful, valuable, please make sure to like this deep dive and subscribe. We'll have more in-depth analyses on the companies and trends shaping our financial world coming your way.